This is 93 Million with Doug Andrew. Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, and IUL specialist. And in today's show, we're talking about the shocking truths on risk in America, the national debt debacle, and what happens if the dollar crashes. And we're joined by the OG of properly structured IUL, New York Times bestselling author, and the author of the L.A.S.E.R Fund, Doug Andrew.
Great to be here, as always.
Good to have you, Doug. Co-author of the L.A.S.E.R Fund and the mad scientist of IUL, Emran Andrew.
I'm excited to be here. Thank you.
Also co-author of the L.A.S.E.R Fund and the top IUL specialist in the country, Aaron Andrew.
Thank you. Happy to be here.
Good to have you. And our featured host for today, a treasure trove of wisdom and one who's never lacking for a comeback, and I mean never.
Never.
Scott Reynolds.
Still waiting for my Fat Chance Millionaire book to be published.
Good to have you, Scott.
No one's wanting to do it yet.
Okay, we have some really fun topics today, so I just want to jump in. Risk tolerance, shocking study. Okay, gentlemen, I've got a really interesting study. And it looks a little confusing, like kind of showed you before, but we'll kind of go over it. And there's just a kind of a takeaway, so don't get too intimidated by it. And then I've got a news report that I want to show you. So there's a study by Nitrogen Wealth, which studied investment risk tolerance by age. And you can see in this graph, the height represents higher risk tolerance, with older ages to the right and younger ages to the left. Okay. The width of the band or the blob in each band represents the volume, how many people are in, those different age bands. And the rectangle blocks just show kind of the bulk of the average. So if you look at the graph overall, you can see that as age gets higher, in other words, towards the right, the overall risk level that, the risk that people are willing to take, risk tolerance, gets more conservative, right? Which makes sense. But if you look at age 60, the age 60 to 70 band, which is the largest volume band, it's the thickest band in the middle.
Most people were surveyed there.
Yes, it's the middle right band. So it's kind of in light blue.
The biggest blob.
The biggest blob. Thank you, Scott. And what's interesting is that in that group, if you look kind of towards the top, there's still a really large amount of that group that are like at retirement or near retirement, right? There's a large group of those that have risk tolerances, investment risk tolerances that go all the way up near 100. So that's kind of interesting. And then, so there's a lot of individuals in their 60s that are still very aggressive, and willing to take, larger risks. Then I came across this video clip from Fox Business. Here, take a look.
More and more Americans are relying on stocks to goose their nest eggs. According to data from Vanguard, workers across nearly all age groups are investing record proportions of their 401ks in equities. Workers in their late 30s had 88% of their 401ks in stocks last year. That's compared to 82% a decade earlier. Even more surprising, people approaching retirement are investing more in stocks as well. According to that same Vanguard data, 401k investors in their early 60s had allocations of stocks of 60%, up from 57% a decade ago. Now, these recent moves turn conventional personal finance advice on its head.
Okay, so my question here is, why are so many individuals, and Doug, we're going to start with you, but why are so many individuals who are at retirement or so close to retirement so willing to be aggressive and take risks? And what's the danger of that, or what are your thoughts on that, Doug?
I think the number one reason is people have this rude awakening that they didn't save enough. They've just been burying their head in the sand and socking away money in traditional accounts like IRAs or 401ks. And then they realize they're not going to make it. They're going to outlive their money. So then they start taking unnecessary risks, trying to make up for lost time. I just did a video recently on my channel, and I said, if you want to calculate how much you need for retirement, you take how much you would like today. Let's say $100,000, okay, net. And then you have to adjust for inflation. So if you think inflation averages 5%, you divide that into what we call the rule of 72, and the cost of living is going to double every 15 years. So let's say you're 60 or 65, and you say, well, golly, how much would I need to buy the same gallons of gas and loaves of bread at age 80? Well, you're going to need twice as much because 5 into 72 is 14.4. The cost of living will double. So now you go from 100,000 to 200,000.
Right.
Then you have to gross it up because of tax.
Yeah.
You divide that by 20% tax, you have to have 250,000, pay tax of 20% to net 200. And what's the financial services industry standard? What do they call it? The 4% rule.
Yeah.
You divide 250 grand of annual income into by 4%,
Right.
and you need a whopping 6.2 million to generate the amount of income that you would like. And people go,
Wow.
yeah. Now, see, that's why I like our favorite vehicle, because ours is tax-free. And you can get an 8 or a 10% payout. So if I only need 200,000 of tax-free income, I only need a $2 or $2.5 million nest egg, not a $6 million nest egg. But most Americans don't know what they don't know,
Right.
and so they're trying to scramble. And their advisors saying, "Oh, only take out 4%." And they go, "You got to be kidding me!" So then they start taking unnecessary risks. I think is the biggest problem.
And 1% of that 4 is fees, and another 1% of that 4 is taxes, because it's 25% of the 4%, and so on and so forth.
Yep.
Yeah.
That's a lot of money to put in your pocket.
That's a
At
lot.
the end of
Emran,
the day.
what are your thoughts, Emran?
Again, I think it associated with a little bit what Doug talked about here. And obviously, we look at the number one fear. The number one fear amongst people that are approaching retirement or in retirement is the fear of running out of money. Yep. Okay, so they're afraid of, a lot of people will make decisions, especially driven off of that emotion of fear.
Yes.
Now, since the 2000s, since right around 2000, what happened? Well, you actually had the feds, for the first time really in economic history, stepping in and manipulating the markets.
Right.
So what did they do? They came in and they lowered rates. They artificially lowered rates, which it made your safe invest bonds not attractive. I mean, if you take the interest rate environment down close to zero, well, of course, if I'm worried about running out of money, but if I want to put my money in safe areas, I'm not earning any interest,
Right.
which means I'm going to run out of money faster.
Right.
My only other, I think my only other solution out there, according to general financial advice, is be in equities.
Yeah.
Right. Really, the political environment and the Feds interfering in our markets is really been kind of at the core of this. If they'd get out of the way, bonds might come back to more of a competitive level, and people could go back into being more safe. But because they've eliminated that option from retirees since 2000, I mean, they don't really have any other option, right? They've eliminated that. So you're like, look, I can either definitely run out of money because I'm not making any interest, or I can risk it in the market and pray that I make it. One, I know I'm going to lose. The other one, I'm like, well, at least maybe I got a chance.
Yeah.
Right. So it's like the better of the lesser of two evils. And so, I mean, again, I pull it back to, again, that fear. And because of that fear, the feds are really, I think, manipulating people with that fear. They were able to really manipulate the markets, drive people more towards equities.
Yeah. And it's interesting. Interest rates have come up in the last 5 years since 2020, but do you think that's helped? It shows that since kind of that time,
but they're still not even
still
up.
people are putting more money in.
But they're not still even up since the early 2000. Since 2000, they're not back to the rates they had in the 80s and 90s.
Okay, yeah,
Yeah.
Good point.
Still low.
What are your thoughts, Aaron?
I would say another thing to talk about is clients or people just don't remember 2008 and 2002 to 2002 when the markets crashed really bad. So we haven't had a big drop in a long time. We had a 2022 drop, a little bit, right? Like 15 to 20%, but it was short. Wasn't that long.
2020 was really short.
2020 was like a month. The COVID dropped and it rebounded really
it was
high.
Really sharp, but it also kind of came back really quick.
And so, I mean, you look at the lost decade from 2000 to 2010, it was like flat, but we had those two big drops. People have kind of forgotten about those, and people don't want to miss out also. And so they're putting money into equities.
FOMO.
Yeah. People do not want to miss out on all the stock. And of course, a lot of stock market is driven right now by the big companies and AI right now and stuff. So it's like the thing is we just got to be careful because too many people are taking too much risk and forgetting about that. Yeah, things could change. We could have a big drop in the market.
Yeah. Scott, you've had a lot of clients you've worked with over the years. How do you view this?
I think part of it is we really haven't felt the pain.
Yeah.
A big drop.
And I mean, I look
Makes
at
a lot of sense
COVID,
to me.
all that free money that was handed out with COVID.
Right.
Where did that go? People were buying baseball cards, Pokemon cards, putting it into crypto, things like that. They're seeing. It was just kind of a boom time to invest.
Right.
But nobody really saved anything.
Yeah.
And I look at the Great Depression and what happened there. That was kind of the same thing. Everyone was buying stocks. You could go get loans to buy stocks.
Yeah, like before the Great Depression.
Yeah,
happened,
before the
right?
Great Depression.
Yeah, right.
And then once the market crashed, people couldn't get access to funds anymore. So I'm afraid that we may be kind of entering something similar to that, but who knows?
Yeah, it's a great question. Is the market overbought?
Yeah.
So
Yeah.
This reminds me of an illustration, a cartoon I had in my third book, Last Chance Millionaire, because I'm a skier, and I think I've mentioned this before.
Yes.
So many skiers at the end of the day, they're tired, they're worn out, and then they try to go for it. Okay.
Right.
And these people
What's
in
my
retirement,
last
they're trying to
run?
go for it. It's the last
of the
run.
day,
Man, we got-
yes.
and they crash and burn.
Right.
And I see the ski patrol and toboggans going and getting people and
They're very active in the end of the day,
yeah,
aren't they?
yeah. And all I'm saying in there, you have to have a strategy so you don't have to worry about crashing and burning on the last run, which is retirement. You ought to be able to ride down in the warmth and the comfort and safety of a gondola. Okay.
Yes.
So that's why I like IUL. It's like
Yes.
it's like a gondola. It gets me safely down the mountain.
Yeah, and coming up next, we're actually going to highlight that a little bit more, as well as if it's even possible to get out of our national debt, which is very big question. It's a $36 trillion
How much time do we
question,
got?
actually. Yeah. So, but first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe and ask us a question or comment. We may even feature it in one of our segments. So, the national debt debacle. According to The Guardian, consumers don't have a debt problem. The U.S. government does. Here's why. Our interest payments as a percentage of total federal spending are ballooning. When our government spent money in 2020, 7% of that spending went towards interest. In just 4 years, that number has more than doubled to 16%. And that's because our levels of debt have increased during that time from 24 trillion to 36 trillion. And
all?
interest rates charged to banks have increased from close to 0 to over 4%. Emran, what's the big deal about the national debt? It's only 36 trillion. 36 doesn't sound like that scary of a number. Why do we care?
Well, yeah, if you take the trillion out of 36, it doesn't sound like it's that bad, right? But I mean, again, it's trying to wrap your head around the word trillion. I mean, people have a hard enough time wrapping your head around 93 million. You know, when you fold a piece of paper
Right.
50 times, it's
Yes.
93 million miles thick.
Here to the sun,
I
right?
mean, that's 93 million. You're talking about 36 trillion.
Yeah.
Okay, million. I mean, it's just
amazing.
mind-boggling, the trillion. And so, I mean, it is a big deal, and it's a big deal because it will eventually, the payments eventually due, right?
Yes.
And that's the problem. You can't just keep on running from the payment. The payment is going to come due at some point.
Right.
And this is going to, this is just going to get crazy. The numbers are going to get crazy between now and 2033, 2036.
Right.
Because we have the point, up to this point, we haven't actually had to go into debt to pay for Medicare and Social Security.
Right.
But that's right around the corner.
That's where we're headed.
Right around the corner in 2028, 2030, we're not collecting enough taxes in Medicare. We're not covering enough Medicare taxes to pay for Medicare. So if you don't have enough money, you got to pay the bills. I mean, you got to do one or two things. You got to either raise taxes or go into even more debt.
Yeah, go into more debt so that you can service the debt that
Correct.
is growing.
And the real critical point right here is one of two things: is do you have somebody that's still willing to lend to you? I mean, as long as you got somebody still willing to lend to you, might you be able to borrow? But if that cuts off, we're in trouble.
Yeah.
We're in trouble if all of a sudden if we're not going to be able to borrow more money. And then again, number two there, okay, then we're going to have to make our paper look, U.S. paper's got to look better, so taxes are going to have to go up. I mean, they're going to have to skyrocket, and they're already super high.
Right.
I mean, they're already high between Medicare, FICA, Medicare, income taxes, property taxes, sales taxes, everything that we look at. I mean, we tax everything in this country.
Tax to the max.
We tax everything.
That's right. And even if you take out the trillion, it went from 24 to 36. That's a 50% increase just as a percentage.
In 4 years.
Right. In 4
years. A 50% return. I mean, if I got a 50% return, I'd be happy, but a 50% negative return.
Well, yeah, imagine if your mortgage, think about your mortgage out there.
Jumped.
If your mortgage
50%.
went up 50%.
Yeah, it went from $1 million to one, now you owe $1.5 million.
4 years.
Yes.
Yeah.
I remember
You'd
in
be freaking
2012
out.
when it was 8.
Yeah.
Trillion?
Yeah,
I
8
thought
trillion.
that was a
The
huge
debt
amount.
was 8 trillion back
Yeah.
then, and we were kind of freaking out.
That's nothing.
It was amazing.
It jumped up more than that from
Yeah.
24 to 36.
Oh, we've blown it out of the water. Aaron, what are your thoughts?
This is not looking good.
Yeah.
This is why it's so important, I believe, this is our favorite vehicle is IUL
Yeah.
because tax-free.
Yeah.
Anything that we can do to help save on, because, I mean, that point that we're just making there is there's going to be a lot of taxes most likely.
Yeah.
Taxes have got to go up. We got to pay for this. So the more you can do to protect yourself to have money tax-free. And this isn't getting around some tax loophole. IUL or Index Universal Life is, basically taking, you've already paid Uncle Sam, you paid him off.
Yeah.
Now we can have money grow tax-free, you can get money out tax-free. When you die, it transfers tax-free, all safe and conservative. And going back to our first segment, we can do it without market risk.
Yeah, and I wanted to touch on this with you guys especially, but some people, sometimes we go, oh, it's tax-free income, or we talk about taxable versus tax-free. We got this national debt. All of this kind of comes into play, but in terms of people understanding what the impact of taxes really is down the road, what does that really mean to people? You know what I mean?
Yeah, the impact of taxes can make a big deal. Let's go to can we see this on the board?
Yeah.
Let's go to the wisdom table, and I'm going to show you guys real quick here. I'm going to show you just an example of an IUL. So this is just an example of what we call, this is Emran's simulator. And what we're doing is we're taking $100,000 a year and we're putting $100,000 a year into an IUL. And we have, after 5 years, so our death benefit's $1.3 million, you can see.
Right.
So with IUL, you have a death benefit, you have tax-free growth. So it takes a bit to get going. You put in 100,000, we got 92, but look down here. In 14 years, this is a 50-year-old, by the way, putting in $500,000. And here in the gray in the middle, balance after tax. What I did is we scroll up here, and we are comparing to another vehicle. I'm putting someone in a 24% bracket right now.
Okay.
This is not assume that taxes go up either.
Right. So just right now, taxes.
So someone's in a 24% bracket, 5% state tax. That's probably about the average in the nation, 5% state income tax.
Okay.
What if we earn 7.5% return, average in this in a tax-deferred account? So account you're going to pay taxes on the gains.
Right.
Okay.
About
Very typical.
12% mutual funds, growth stock mutual funds.
That's another
1% management fee, very typical. Over on the IUL, I'm assuming we're going to earn 7.5%, same rate of return. It's going to have its fees and expenses. Put in $100,000 a year into each one. Okay, so we scroll back down here. So you put $100,000 a year into each one, and the IUL's only got 92 at first. IUL's a long term, but you got 1.3 million if you pass away.
Okay.
The taxable account has 102 because of the taxes. Okay, the after-tax balance. Let's go to 63. By 63,
Clearly already better.
Yeah.
More, right?
they're better than we are at first. But here at age 63, they've got $800,000. We've got $969. But what is ours going to be from now on now? Tax-free.
Right.
The other account, you got to pay taxes. So here we take out $90,000 a year out of each one. The taxable account, because you got to pay taxes, you have to take out more to net 90
Right.
in that 24% bracket, because we assume this is on top of like a pension, Social Security. So you see the gray account here, the balance runs out of money at age 76.
Yeah.
So at 76, you're out of money if you're taking out the same net number. In the IUL, we still have $700,000. Now, in other episodes, we've talked about this. You got $2.4 million in there still earning interest for you, but you've got a loan balance of 1.6. So you have a net of 700,000, a net 700,000, and if you die, your family gets 770,000. So we are $770,000 better than they are, but, and this is because it's tax-free. This is the point Greg wanted me to get to. This is all because this is tax-free.
It makes a huge difference.
And you keep going, we keep taking out 90,000 a year. It actually, by age 100, there's like 3 million still left. The taxable investment ran out of money at age 76. Same interest rate. Now, We got there safer with guarantees and IUL you can't lose. We generated a higher income also because it was loans. Don't think loans are negative. Loans are a good thing because you're borrowing at 5 while your money's still earning 7.5%.
Those loans are what allow your money to stay in that, policy earning interest.
Yeah, so the money, you're not withdrawing. Your money's still in there. So you're earning 7.5% on your money still, even though your debt or your loan against the policy is being borrowed out at 5.
Yeah, look at where they run out of money. We're earning interest on $2.4 million.
Right.
Yeah, so great. Scott's saying we're still earning interest on 2.4, not on 700. We're earning interest on 2.4. We have a loan balance of 1.6 that's being charged 5%. You're not paying the loan interest. It just adds onto the loan.
Right.
But we have $700,000 net of the loans when they run out of money.
And you mentioned protection from losses. We were just talking about market volatility in the first segment, so it provides protection from market volatility, which is the concern we talked about in the first segment.
Yeah, the first segment. If we had a big crash like another 2008, we get zeros a hero, we don't lose.
Yeah.
And you reset. So annual reset, you reset. So the market crashes, you get 0, and then you reset at a lower point of the market, and you get gains from there forward. Yeah. So it's pretty powerful. It's a simple example of comparing an account that you have to pay taxes. Now, just imagine if taxes went up.
Yeah.
This would be if taxes went up. Even if we lowered the bracket, I've even lowered the bracket, and we're still going to blow them out of the water. Even if it was a 15%, 20% bracket, but even if taxes go up, this chart looks even better.
Well, and you can't even be in a 15%. You're going to have to be in a 22% bracket if you got over $90,000 of income anyway. You're right. I mean, you're got to be in a 22% tax bracket, right?
Right.
Yep.
Right. So.
I mean, I can even, I've got another simple summary of this as well. If you're talking about this, I mean, the national debt is really about taxes, right? It's about, the threat is the way to solve this is you're going to want to significantly, whether it's a, industrial revolution, now it's like the AI, whatever, the information revolution, a massive economic growth, right? You're going to have massive economic growth to be able to have significantly more income to tax it so we can pay this debt.
Right.
I think that's the best going theory of how to tackle this. But at the end of the day, they're trying to raise revenue so they can collect more taxes.
Yes.
Yeah.
Okay, so again, just looking at a simple summary, most Americans save money. Well, let's pull up the wisdom table. As we pull this up right here, most Americans save money where?
IRAs and 401ks, tax-deferred accounts.
So here's an analysis we did for an actual client. They got $2.5 million. Okay, they've got $2.5 million or $2,250,000 sitting in their IRAs and 401ks. Okay, that's all yet to be tax dollars. Mm-hmm. And I am going to show over here. I'm going to show looking at moving that money over. We pulled $230,000 out, net after tax $144,000, and we're going to stick that into an IUL. The IUL has a death benefit of $2.3 million in case they pass away, and then we're going to generate income of $160,000 a year.
That's transitioning it and taking the money out, paying the taxes, moving it to an IUL to a tax-free status, right?
That's correct.
Okay,
so let's go ahead and move over and look and see what the overall tax analysis is on this. Okay, so if this client right here, they're actually 68 years of age. Okay, so we're looking at 68 years of age. They're going to have to start taking out RMDs. Now, this was a few years back. So RMD at that time was still at age 70.5. I know it's at age 73 now, but when I did this analysis for this particular client a few years back, the RMD age was at 70.5. Okay, so we go okay there. So we got $2.5 million. I'm projecting it growing it even at 8%. Okay, projected growth of 8%. If we look at the age 100 simple summary right here, age 100 summary is showing here that the client still owes, okay, after taking out RMDs, okay, they still owe $600,000 in taxes. They're heirs. If they die, the heirs are still going to have to pay at least $600,000 in taxes. Now, they've got $674,000 left over, but that's so you're looking at, you already owe $600,000. How much in taxes have you paid though?
Yeah.
Okay, let's look at this right here. If we look at this right here, the amount of taxes you're going to have to pay over your lifetime is what? I mean, you're ending up paying $2.5 million in taxes on those RMDs.
Wow.
So they just do what most people do and take out the required
RMDs.
minimum distribution. They're going to pay that much in tax.
Uncle
Two and a
Sam's
half.
like, thank you very much.
Yeah.
Plus, you still owe the $600. So that's over $3 million in taxes.
Wow.
Now, obviously, what we did for him is we showed him how to get the taxes over and done with right away. And we did get it by the first few years in retirement. By the time he was age 81, we got all of his taxes over and done with. We only paid $1 million in tax. It's still $1 million in taxes, guys.
That was the first thing you showed of doing a rollout.
Yeah. So, I mean, $1 million, though, if I pay how many of you would rather pay $3 million in taxes if I could eliminate 66% of your tax bill? Right. We just eliminated 66% of the tax bill. Plus, once again, you look at this here. They left behind $1.1 million inside their L.A.S.E.R fund. They left behind $1 million.
Yeah.
And they generated $4.6 million of income.
Wow.
Compared to only $2.7 million of net income after taxes on their IRA RMD. So I got 4.6. So again, at the end of the day here, I mean, you just can't, it just works. The L.A.S.E.R fund leaves behind 1.1 million. Okay, the L.A.S.E.R fund leaves behind 1.1 million compared to only leaving behind $600,000.
And your kids have to burn through that in 10 years or they get a 50% tax bill.
Exactly.
With inherited IRA rules, right?
Yeah.
Like you got to spend $2.7 million in your lifetime in the IRA net after tax. We got to spend $4.6 million. That meant you add those two together over their lifetime. That's a $5.7 million asset value
Total
compared
resources.
to a $3.3 million asset value. That is a $2.3 million increase. I mean, that's almost a 100% increase. That's like a 75% increase in their results.
And
but that's how you do tax planning. When you look at when you're worried about the national deficit, it's all about how does this affect you? It affects you on your taxes. How are you going to pay your taxes? You're going to pay $3 million in taxes, or are you going to pay $1 million in taxes?
Well, and your future generations, because also that money that your kids have to burn through in 10 years is probably going to throw them into a higher tax bracket. So they're going to end up having to pay more in
So it
taxes.
perpetuates the tax
It
problem.
perpetuates the tax problem.
Yeah.
And Uncle Sam just sits there rubbing his hands together.
Yeah.
So
That's a great thought. Well, that's pretty amazing. Okay, Doug, do you want to give us your final thoughts on this subject, this segment, before we move on?
Yeah, I want to shift focus. So what if you were over this $36 trillion debt? You're a politician, okay? And you're going, oh my heavens, we're only bringing in 6 or 7 trillion, okay? And we've got 36 trillion, which, by the way, you divide that by the households in America.
Oh,
And that's 360 grand, roughly.
Yeah.
Every single household owes 360,000. Okay.
sick, yeah.
But let's get back to the government revenuers. They're looking at this deficit and they're going, who has the money?
Yeah, where can we find it?
Who has the money? Okay.
Right.
And retirees.
With money in IRAs.
They have money in
401ks.
IRA. How much? It's estimated 28 trillion. Round it to 30 trillion. Okay.
Okay, yeah.
Ooh, look at that nice little nest egg we can go after. So, yeah, what Emma was just showing you, if you have money sitting there thinking that you're going to save tax by putting it off and taking RMDs, think again. Because that's their little nest egg they're going to go after. And the Consumer Finance Protection Bureau, which didn't Trump get rid of that, but one of the purposes, the hidden agendas there was, let's require fiduciaries to have their clients have, maybe we'll start out at 20% of all IRAs and 401ks should be invested in U.S. Treasuries. One way or another, they're going to tax your money, and they're going to borrow the money by requiring fiduciaries have a certain amount of your portfolio in U.S. Treasuries. Okay, now that hasn't passed thus far, but that's what their hidden agenda was.
Right.
So beware. That's why we suggest
they
get
can
the money
change the rules,
out.
too.
Don't roll it over.
Right.
That's from the frying pan to the fire. That's rolling money from a 401k to an IRA, being duped into waiting until you're 73 now and then taking RMDs. That's the worst advice.
And don't be duped into thinking that they're going to be, you can just go get this from all the wealthiest people in America.
Yeah, that's not going to work.
Elon Musk's entire net worth cannot even cover even 1 year's worth of interest.
You could seize all that money.
You could
still wouldn't solve the problem.
Even if you went to a communistic environment, even
Right.
if you seized, it still doesn't even touch it.
Yeah.
Yeah.
You can't tell me, though, that the politicians aren't looking at that $30 trillion and
IRAs
already
and 401ks.
already
Yeah.
spending that money.
Yes.
They've
Well,
already spent it.
They're already posting it as collateral
Yeah.
for the debt,
Yeah.
right? They're
Well,
already posting it as collateral.
When you look at the government, you don't think of them as being very smart. But when it comes to collecting your taxes,
yes,
they're,
taking your money from you.
they're really efficient. They're really good at
I don't know
making
why we
sure
really-
they get their tax.
Why did we bring this up anyways? It's not our problem. This is the government's problem.
Yeah, it's not a consumer debt
Yeah.
problem. It's a government
Yeah.
debt problem. That's right. All right. Well, coming up, what happens if the dollar crashes? But if you're enjoying this content and you're wondering how to take advantage of these ideas, L.A.S.E.R Financial helps individuals and families like yours implement proven strategies to grow and protect your wealth. One of the most powerful tools is an indexed universal life policy, or IUL. It's not just insurance, it's a tax-free retirement strategy, a way to grow your money with compound interest and a safety net against market downturns. Imagine being protected from market losses while still participating when the market goes up and having tax-free income that allows you to keep more of what you've worked so hard to save. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait. Take the first step toward a brighter, more secure financial future today. Are you a financial professional wondering how you can expand your business working with IUL? Are you leveraging IUL to its full potential? That's where IUL Insiders comes in. In the upcoming weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals to help you build a thriving, scalable business that sets you apart from the competition. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and for your bottom line. If you're ready to elevate your practice and scale your business, visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. Question of the day. Our question of the day comes from Jamal on YouTube, who says, what happens to IUL if the dollar crashes?
Okay.
Okay. It's a pretty heavy question,
Never
all right?
heard this one before.
Yeah, and it's actually one we've heard many times before,
times.
right, Scott? That's a pretty heavy question, but one that we've actually see pretty often. According to Investopedia, it seems incredibly unlikely, considering the U.S. dollar composes 58% of the world's primary reserves. And 8 pretty catastrophic events would have to happen for the dollar to collapse, including a deep recession, inflationary spiral, and a shift to other currencies like the euro or the yuan, China, okay?
They are a lot more stable.
Yeah, you'd say. Aaron, we'll start with you on this. You've had many clients over the years that have asked you this question. How do you respond to this question?
Okay, so this is exactly what you just said. Those things kind of like need to happen, which is very unlikely. Honestly, you guys, bottom line is if the dollar collapses, we got bigger problems.
Right.
We have much bigger problems. If the dollar collapses, financial stuff is gone.
Because
Everything.
it affects all finances, whether it's IUL,
Everything.
stock market, IRAs,
Money in the
401ks.
bank,
Yeah.
everything's done. Everything's gone.
Yes.
So, and like, you know, I think I got this from you, Scotty. We're down to what we call food storage and guns. Okay.
Yeah.
So it
That's
kind of,
going to be your investment that you'll want.
yeah, like honestly, it's like if you are a doomsdayer, which we get a lot of you out there, and it's okay. But if that's the case, you need to have, you know, your real protection stuff if that happens. But honestly, the insurance company,
even gold and silver is not going to help you at that point.
nope, it's
Like,
not. It's
Again,
down to
it's bartering.
You can't
Yeah.
eat gold.
At that point, you're bartering, and I don't
You want
care
food.
if you
the
got
value of it maybe.
Yeah, if you got a brick of gold and I've got a pound of flour, I'm like, I can't eat the brick of gold. Why don't I mean now the value of gold is going to plummet in that kind of a situation because it's no longer
That's
useful.
a good point. The flour or the food commodities would actually probably
Correct.
appreciate in value.
Commodities are
because
going to
they're commodities.
skyrocket.
to be worth way more. So it's like, if this really happens, we got bigger problems. Everything's collapsed. It's done. But the insurance companies are super safe. They've been around, you know, for 100 to 150 years. All the companies that we use. So when we were talking IUL, the insurance companies are the backbone of the financial system.
Weathered
so.
the Great Depression.
Yeah, like 2008, for example, the Great Recession, fine. All the companies we used did great through the Great Depression.
Right.
So insurance companies are super safe, super solid. It's one of our safest places we feel to have our money. It's not FDIC insured, of course, but you got the stability of the insurance companies backing
Guarantee
it.
Association and
Yeah, there's just so much protection built in.
insurance, reinsurance, yeah.
So all that, and being tax-free is just huge. So we feel like this is one of the safest places and the most guaranteed places to have your money, because we can use the word guarantee. The insurance company guarantees your money. If we have 2008. So, yeah, I don't think it's very realistic to say the dollar's going to crash. If it does, bottom line, we have bigger problems.
Scott, you have really good insight on this. What are your thoughts?
Yeah, I lived in Brazil in the early 90s when they had as high as 19,000% inflation rates.
19%?
19,000%.
We can't wrap our heads around that. Can
Yeah.
you even imagine?
So you
hey,
got-
Doug, rule of 72. How?
Yeah, right.
What's the rule of
1,000.
72?
Meaning if I had $19,000 in it's
cost
worthless.
is doubling
Yep.
every
It becomes worthless.
every-
like hour
every
or
year,
something every day.
Yeah, you got paid. You went and spent it all
Oh,
that
there's
day.
no reason
because
to hang on to your
tomorrow,
money.
tomorrow it was worth half as much.
Yeah.
And we survived 3 monetary systems. So when I got there, they had the Cruzeiro Reais.
Wow.
And then they switched over to this thing called the UEV,
I've never heard of either of those.
right? That was interesting. It was a daily chart that would have the value of this UEV. And then they now have what they have today, and that's the real.
Wow.
And that's the monetary system that they ended up. But they had to burn through all this money because they had high inflation.
Yeah.
But guess what? We survived 3 monetary systems.
Wow.
Yeah.
And so
and each time they switched over, what did they? I mean, if you had the old monetary system, did you just throw it in the garbage, or did they bring
you had
it
a
in?
month to bring in your old stuff and swap it out for the old monetary system.
Exactly. That's exactly what
Or
would
the
happen.
The new
That's
one.
exactly what would
Yeah.
happen if they collapse the dollar.
Yeah.
You turn in your dollar to get new, whatever it is. I've called it oranges. Trading your dollar, you're going to get all these oranges.
Yep. People, you would think that it was a massive panic. No, it was kind of weird because it was like
Had a
no
month
big
to
deal.
go
yeah,
trading your money
You
and
just go swap out
just
your
make
your
sure you
bills.
spend all your money. I mean, that's crazy,
Yep.
but it's actually interesting the way you put it. It doesn't sound as like
Yeah.
end
So
of
if the
world
American
kind of-
dollar went away, it might become the American real. I don't know, but
Yeah.
it's
But-
it's not going to go away.
But like Amron, what would have to happen for the American dollar? Like, who would have to eat our lunch for the American dollar
Right.
to not be the worst?
I mean, your
currency?
greatest opportunity, right? I mean, the comfort you have right now is every other world currency is worse than ours.
Yeah.
Right.
So now you get into again, go back to the theory of relativity.
Right.
Okay. When you look at in the theory of relativity, it's okay. Ours, the dollar is weakening, but in contrast to every other currency that exists, it's actually still the strongest currency out there.
And that's what matters.
Yeah.
the most.
And that's what it's the relative nature of the currency that matters more than anything.
Yeah.
And so until another currency could actually, and even if that, I mean, if it hits it there, I mean, I don't even know what would. I mean, a lot of people talk about China, but China's going to go through one of the biggest economic collapses we've ever seen in world history.
Yeah, they're
Because the one thing you have to grow an economy, it's unfeuded. In order to grow an economy, you must have
Growing
population
people.
growth.
You
Growing
need people and
population.
People.
productivity.
And they have a restriction on how many kids you can have. In fact, their restriction forces China to have a declining population.
Well, and I think they're trying to undo all of that.
They're trying to, and that whole curve. I mean, you're going to try to uncurve it, and it's going to hit here.
Well, and what's China's economy based on? American production, right?
Yes.
So if we stop
Yes.
spending money,
Right,
they're not
they
gonna-
actually get worse.
Yeah.
and it's
Correct.
funny because a lot of people, clients, and I've had the same question over the years, but they think it's like, what happened if the dollar crashes? Like they're gonna wake up one morning and there'll be a news report, the dollar crashed today. You know what I mean? Like
Right.
it doesn't really work like that.
No.
Right? I mean, can it happen overnight, or do a lot of things have to happen for the dollar to?
Yeah, I mean the 36 trillion or whatever we talked about's not helping, but
Yeah. Right.
it's not going to.
Other countries are worse off than we
Yeah,
are.
we have too much land in America that we could cash in on. So there's ways
we have
that
tons of resources.
there's tons of resources.
And there would be a lot of, we'd have to see more and more red flags over time
Yeah.
to get to something where we looks like that. But
Just-
otherwise, it's just the tail wagging the dog.
Just
right?
watch California
That's
and New
not
York
gonna happen.
City over the next couple of years. And if they fall apart, then we may be.
We'll have to keep an eye on that situation. Yeah, just to keep an eye on it. All right, Doug, final thoughts on this subject. Wrap us up, will you?
Yeah, and I've been asked this question a bazillion times, and I never exaggerate.
Wait, is that accounting for inflation?
Yeah.
You've been asked this 36 trillion times at least.
Yeah, if the dollar crashes, okay. So sometimes I say, well, do you mean becomes worthless?
Yeah, like
okay.
what do you mean by the
what do you mean by the dollar crashing?
They don't even know what they mean. They just have heard it.
What we've been talking about, the value of any financial asset, if the dollar crashes, will go down. Now, IUL, because it's in the multi-trillion-dollar insurance industry, will just go down slower, and that's why I choose to put my serious cash there.
Right.
There would be lots of forewarning, but okay. So now I have a warning because the banks are in trouble, and the credit unions, and even real estate in the Great Depression. Some real estate dropped 80%. Okay, so I hurry and convert it to what? I convert my IUL to gold? No, you can't eat the gold.
Stock market?
No, what do you convert it to?
I don't know.
So that's why we become a bartering society.
Right.
And that's why it behooves you to have the ability to barter with other people, because that's what's going to be valuable. You better be able to grow carrots in your backyard and then be able to
Have
trade
some type
those.
of skill that you can trade for.
So I'll trade my carrots for your chickens and whatever.
Right.
So it's sort of a question like, do you know what the world would be like? If the dollar crashes, it's not going to matter.
It's like what Aaron said. He said we got far bigger problems.
Where should I have my money if the dollar crashes?
You don't have any money.
Money's worthless.
In the fire.
There is no such thing as money anymore.
Yeah, okay.
That's what that means is literally what
Anyway, okay.
That's great. All right. Well, that's all the time we have for today. Protect yourself from market volatility, rising taxes, and inflation. And we will see you next time on 93 Million. Bye.
Thank you. See ya.